So putting that money instead into whole life, making sure that it's providing you that death benefit no matter when you die, it's a very essential mindset change that I would encourage the listeners to look into.
The majority of people trade time for money in the hopes of building wealth. I'm here to tell you that the traditional methods don't cut it anymore. Welcome to the Passive Income Power Podcast. My name is Doug Earthman. My partner Mickey Bernstein and I are going to dive deep into the power that passive income can have on your quality of life. We're going to discuss alternative assets, strategies, and insights through interviews with the very people who have found freedom through their power. I hope you enjoy this episode of the Passive Income Power Podcast. Thanks for tuning in to the Passive Income Power Podcast. I'm your host, Doug Earthman, and today we have our friend Madhavi, who is the president of Think Outside the Stocks. She's an active syndicator and operator that aims to educate people about wealth creation and strategies. Her story is fascinating, from immigration to the 2008 crisis to her corporate exit and then into real estate, which we'll get into here shortly. We're excited to talk to her today to inform our listeners about a very powerful wealth building tool called infinite banking. Let's get right into it. Welcome, Madhavi, and can you tell us a little bit about your history and fill in any blanks I may have missed?
Absolutely. Thank you so much, first of all, Doug, for having me on your show. It's a very powerful show. I think you and me are trying to educate other people. The strategies that we found along the way, and we kind of, couldn't just keep it to ourselves, right? So first of all, congratulations and thank you for doing this for your listener. Even we can impact one person in a day. That's worth it, right? So with that, thank you for alluding to my introduction. I'm a first generation immigrant in this. So my story actually starts when I came with like two suitcases, 9,000 miles away from my roots. I never wanted to leave my city, by the way. So I came here with my husband and we started from scratch in this country and, start living that American dream, working towards it. There's a lot of people like me who struggle through visa issues, who are first generation immigrants, don't know ways of this country, how to do things. And we kind of, plug ourselves and we restart our life here. So that's what me and my husband did. Visa issues are real. Just to get transferred from my dependent visa to actual, working visa, that was a struggle. And I find up myself to be that fortunate ones who was able to do that. Unfortunately, many housewives who are capable, they are still not able to do that. So that's really sad and unfortunate for me to see, and kind of, feel very passionate about that too. So I got a job into one of the top 5 consulting companies. Me and my husband, with both of us working, kids born here, we purchased our first house, and we felt like, we are living an American dream. With that, then 2008 happened, and there is two parallel paths, right? In 2008, the housing started crashing. So obviously the house that we were in, that went down significantly. And on the other line, the other parallel path, the jobs were getting impacted. So at the time, me and my husband both worked on the same project. I was about to give birth to my second child. And we just got to know that our project ended on the same day. So the next week is going to be our last week. And that was a sudden jolt for us, because in IT terms, once your project ends, you kind of at risk of losing your job, right? So that's when we transferred from California to Austin, Sacramento, and that's where we are right now. And in the process, we did have to, come out of our house. So that was kind of a painful kind of punch in the gut too. Then that happened, but we again kind of rebuilt ourselves. We were, by the way, all the way in the stock market during that time. Very little savings. It's not like we had a huge chunk of money, right? But it was all in stock market. That went down. So that was kind of, again, a learning lesson for us too. And with that, we restarted our life. We rebuilt ourselves, continued working in that top 5 consulting companies. And in 2015, unfortunately, with my health, I came to a point that I just couldn't continue working. So I had to take that screeching halt to my corporate career, my six-figure earning career. And Doug, you understand, when we have this kind of a great career path going on in consulting, and we are on the career path, financially we are on a great path. It's kind of tough. It's kind of tough to kind of put that break for health or to take that decision. And but that's what I had to do. And I'm actually looking back, I think that that was a great decision, because if it was not for that break, I wouldn't have known this alternate path. So my journey has started in real estate very traditionally, right? The single family homes, Airbnb. My biggest motivation factor was when I left my job is looking at my daughter, who was at the middle school at that time, that hey, she's going to be going to school pretty soon, and I don't want to choose based on what we can afford to send her to the good school, but what she's capable of. So that was my biggest why behind building this kind of a reverse order of financial freedom, or the alternate income path for me, right? But soon I found out about these two strategies, the infinite banking as well as the syndicated real estate, which is you are a big proponent of, and you are a huge on educating people on that. So those two parts, when I realized, I was mind blown. I was mind blown, and at the time I was so restless that if we had this kind of in a parallel universe, almost like a multiverse, right? The Marvel's multiverse, people are doing this all kind of different strategies and building their wealth and growing their wealth, and we think that okay, we have to work hard, we have to save our money, we have to put it into mostly in stock market, and why is our wealth not growing as rapidly as they are doing, right? So that became my passion, that restlessness, that why does people not know about this. And also finding that okay, people are not getting right education, that simplified education. That's the passion behind why I started Think Outside the Stocks.
I had a very similar aha moment with discovering the world of private real estate offerings and syndications, and felt like I had to just spread the word to people, and
Hmm.
share my knowledge and educate people as I learned. And it was that was one of my aha moments where I just knew that that was this was a path for me. Um,
Absolutely.
and so you started out in real estate with single family rentals and grew a portfolio, correct?
Yes, that's correct. I mean, it's a small portfolio for single family rentals, but I soon realized that, though the tax code says that the rental income, being a landlord, is a passive activity, it's not truly a passive activity now. It is. With all the tenant, toilet, and trash. And I had significant experience with my tenants. They were paying well. They were, on time. If they were delayed in payment, they were paying with the late fees. But they happened to literally trash our house in a significant way that we had to spend significant amount of money and time and headache. That stress was incredible, to just bring it back to its own glory so I could rent it to somebody else after they were gone. So those are the experience. I think what happens with the single family rental portfolio, that till it goes well, it goes well, but once you get that one tenant, that one incident, that starts happening, and that just turns the entire experience really really sour. And just the whole idea about how much babysitting that you need to do for that activity, so-called passive activity, it's not really, it doesn't really become a passive activity then. And that's why I like the syndication world, and I started as a passive investor first to understand this investment opportunities. And I started asking questions, I started learning, I started learning about how to evaluate this opportunity, and that's when I turned to be on the active side. By the way, I have a fund now where I bring in this investment, so we as a fund go, it's a big check on these investments. But during that time, right, what's really important to know is that the syndication for passive investors, busy professionals, it's simply that they can put their money in and let the expertise take care of it. Let the syndication team, who are the expert, you can leverage not only money from the bank, but you can leverage their experience, and you can literally sit back and enjoy that ride. I have a Tesla, so I call it that it's a passive income on autopilot, pretty much.
Another similar experience is, I never got into the single family rental space, but I was looking into it very, very heavily. And
Right.
I just saw a lot of time, energy, and risk. And I just was determined to figure out some way that, I'd never bought a single family. I'd bought my primary residence, but I'd
Hmm.
never managed renters. I'd never done it before. And I was like, man, this is, a lot of money to be spending and
Yeah.
diving into something that I'm not an expert at. And how can I lever other people's expertise and learn at the same time? And I did the same thing. I started investing as a passive investor in some syndications, and I was able to lever others' expertise. I was able to learn the process without
Uh-huh.
taking on all of the risk during the learning
Yeah.
process. So that
Right.
was a very similar experience, and just seeing the return profiles as a passive investor versus
Right.
there's some great returns, don't get me wrong, in single family portfolios, but there's
Uh-huh.
also a whole lot of work that goes into it. So when you're looking at risk reward, and it seems like passive investing and real estate syndications, just they take the cake.
Yeah, absolutely. And first of all, congratulations that you skipped the line. You skipped the line of the single family and jumped right into multifamily. I wish I had known that, and I had done that. And what you're saying is really, really important, right? It's a risk managed investment. It provides you better returns than the typical stock market by taking, a risk managed approach. It also provides you those tax benefits directly, better than what single family can provide. So not many people actually understand that. I focus on the tax leakages a lot when I talk to my investors, that that's a key component. You're kind of harnessing the growth of the expenses that you would have paid as taxes too. And on the other side, as a passive investor, I mean, you are an engineer. I worked in the IT and tech industry. We know that there is a lot of work. There is, I spend about 50 60 hours a week in IT industry. In that area, when we are spending so much time, if person like us has a passive rental real estate and they have to manage it, and they have to spend that x amount of hours, rather they spend that x amount of hours with their family, with their kids, doing what they like and what they're passionate about. And that's what the life giving back, that life portion of the life back to them, and having not to worry about, oh, do I have to put a tenant there, or did he destroy my house, or is he paying on time, those kind of stuff. I think that's really, really important to kind of get that sliver of life back as a passive investor.
Absolutely. So another topic that I wanted to bring up, that you're
Hmm.
helping me educate me and get me into this, uh, basically investing tool and savings tool, is the concept of infinite banking. I wanted to see if you
Yes.
could give us a little overview of infinite banking.
Absolutely, Doug. And that's my favorite topic to talk about, because what happens is that the strategies, when I found out about them, The real estate, people have been still been able to find out more about it, learning more and kind of investing in that cycle. But infinite banking, in fact, it's older than syndications. People like Rockefeller's family have been using it for generation after generation, the strategy. And I was mind blown that people actually don't know about it. Even in the real estate realm, people don't know about it. Or if they have now known about it, they don't understand it completely so that they can implement in their kind of a financial structure, right? So I'm really really passionate about first of all keeping that education foot first, to educate, kind of simplify and explain that, the basics behind infinite banking system. And you are taken that you have taken that step, and you are trying to understand it, and you had your aha moments, right, in
Mhm.
that session that we had. So I like to bring that, I like to bring that to the attention of people, that how they can utilize it. So let's talk a little bit about that. Infinite banking is not, first of all, an investing strategy. It's a saving strategy. It's a strategy that you can create your own banking structure, and you can start using that banking as a structure in your finances, whether multiple purposes, whether you want to invest from it, whether you want to do your kids education from it, and whether you want to draw your retirement income from it. So it is a multi-purpose kind of a vehicle. So again, I say that it's solving a problem that you didn't know that you have, and
Mhm.
that's your savings problem. Right now we save our emergency funds. I call it a sleep well fund. Whether it's going to be about, okay, if I lose my job, what can I rely upon? If I have a medical emergencies or business emergencies, what can I rely upon? And that money is different for everybody, right? It could be 10,000 for somebody, it could be 30,000, 50,000, anything of that sort, right? And for the lack of proper institution, we keep it in the banking institution, FDIC insured. That kind of gives us assurance that, okay, I'm not going to lose that money. But I like to challenge that perception, that think about it. If you are keeping in the banking institution, first of all, you are getting fluctuating interest rates. Couple of years back it was less than 1%. Right now people are happy that it's about 5% or so in money market accounts. But that interest rates is completely fluctuating, right? The banking institute itself, there have been different challenges we have seen in different market cycles. The second problem is that when you get that 5% or less than 1% interest rate, you're paying the taxes on it, and this sits on the top of your tax bracket, by the way. So if you are that 25, 30, 33% tax bracket, that 5% is going to be subject to that tax. And the third problem is that your if your inflation is higher than your interest rate that you're getting, your actual growth of that money is still negative. A
Mhm.
lot of people do not understand that, so that's the problem around it. So you got to have the steady kind of growth. For that you need to have that stability of the inflation hedge that it can provide, and the tax leakages, avoiding that tax leakages itself, right? So the infinite banking system in a nutshell, and I'm going to say this very slowly because each and every word I'm going to say, it's really really important. The infinite banking system is based on a whole life insurance chassis, but it is not your typical life insurance. It is structured very, very specifically on that chassis. It just uses that. It is based on a product, whole life insurance, dividend paying with mutual companies. Every word that I said, like I said, it's really, really important. And I'm going to spell it out a little bit about that. First of all, when I started educating people about infinite banking system, in fact, when I learned about the infinite banking system, and I realized that, hey, it's based on life insurance chassis, right? So the word life insurance kind of have a negative connotation to it, and just because how in past in different countries, how the agents kind of have pushed on it, it's more of become like a pressure tactics and things like that. People do not have a good perception of it. But I would challenge your listeners today to keep that away a little bit for some time and listen to it thoroughly. And in fact, I have dropped my podcast episodes which talk about this in infinite banking in detail, episode 17 and 18, if you want to go to listen to it. But essentially, what it is that it's dividend paying. These mutual companies have been existing over 150 years plus. So you putting your money, pushing your cash instead of keeping into the bank account, you're pushing into here. They pay dividend after dividend year, which has a consistent history. Even if you go back, like 50, 60 years, they have a consistent history of paying this dividend. It grows inside tax free. You can contribute to it based on what limit that you want to contribute. So it's not like your qualified plans that only for 401k you can only contribute x amount, or for education you can just contribute whatever that limits are. And you can withdraw from it for any purpose at any age. It's not restricted by age. You can draw your retirement income if you are 55, if you want to retire at that point. You can draw your education, and if that education money does not get kind of used for your kids, you can utilize that for completely different purpose. So you can first of all contribute without any limit. You can withdraw for any purpose, anything that you want. It's growing inside tax free. It's earning that dividends in consistent basis, which is providing you that better growth than bank. And now you have created a machine which is kind of snowballing for you, and which can be used for multiple purposes.
It's such a interesting concept because you're right. It's when you think of life insurance, I knew about, had a term life plan. I had always been sold on getting a whole life plan, and I knew
Hmm.
that whole life created a cash value that I could borrow against, but
Yep.
that's the extent of the knowledge I had uh, of of that type of product.
Right.
And even more importantly, what you're saying is not all whole life policies are created the same. And this is a very
Right.
specific type of whole life policy that creates dividend growth. So
Yes.
I think that's all very, very important to know that, some of the listeners might say, well, I have a whole life policy. Well, it may not be exactly what we're talking about.
Yep, and you're absolutely right. Because not first of all whole life are created the same, like you said, right? And this is a very specific structure. And I give an example. If you kind of go to an architect and ask him to draw a plan for a 3 bedroom, 2 bathroom house, and then when you go and start building, and you have an additional member in your family, and you're like, "Can I make this a 5 bedroom and 3 bathroom plan?" You cannot do that. And that's exactly what the whole life policy, if you are one of you are holding this policy, is going to be that it's a small structure. We kind of want to pull that structure, stretch it out so that you can fit more money into it, more cash into it, so that it can start building that snowball for you, right? And few of the basics that I would like to bring up when you're thinking about this infinite banking as a concept, right? The two basics that I like to insist on is, first of all, when you look at your financial structure, I look at it in kind of a pyramid, Maslow's pyramid structure, right? The pyramid, the bottom of the pyramid is your foundation of your financial structure. That foundation is very similar to what your house foundation is. It's a concrete foundation. You need to have all kind of guarantees in that. Even though it's conservative, it needs to be guaranteed. Even whether any weather kind of impacts, the foundation needs to be so solid that it does not budge. That's how your financial structure should be. And as you start going up, you're maybe taking more risk, more rewards possibly. You're kind of losing a control too. And on the top of it, it's kind of a speculative, right? Maybe like stock market and something like that. Many times when clients come to me, they have their pyramid inverted. They have, their speculative sitting in the stock market. That's the maximum of their financial structure sitting in there, right? So you got to think about that. Changing that perception is not just about how your money is being invested and it's growing, how is what is the rate of return of that money. But if you step back a little bit, kind of an eagle's eye perspective, it's about growing, preserving, protecting, and passing your generational wealth. So infinite banking system sits at the foundation of it to help you do all this. So that's number one basic. And second basic is the magic of compounding. Einstein says that, compounding interest, that's the eighth wonder, because, the one who understands it earns from it, and one who does not understand pays it, right? And why does he say that? Because when compounding is growing, and especially the uninterrupted part of it is really, really crucial. If you kind of put in a money, about $1,000 a month, which is growing at the rate of 6% compounded year after year, and you put that consistently for 30 years, you have a capability of reaching to $1 million just from that compounded growth. Because it starts kind of slow because it's adding that interest, but then when the principal starts becoming bigger and bigger, it gets that hockey puck growth, and it's a snowball created. That is the concept that we want to harness and put it into infinite banking system. The infinite banking system provides us that vehicle to create the uninterrupted compounding structure for our savings. Now you will ask me that, Madhvi, if I'm putting my money in there and it's uninterrupted, I'm not taking out, how do I use it for other purposes that you just tell me, right? So you do it by creating a leverage very similar to your home equity loan, where, when you have, say, hundreds of thousands of dollars in your home equity and you want to invest into something and access that, you don't have to sell that home and come out of it and become homeless, right? You can go to the bank, say that give me a home equity loan, and then you can take that money and put it to different use. You can do that with your infinite banking system. And what happens is, if you have taken that leverage, you can either start returning it back in the chunks that you have kind of started to access. You can utilize it for investing. It's called an and asset for a reason. The money does not come out, so it's uninterrupted growing inside the policy. You go to, say, insurance company and say that give me the loan collateral based on the collateral that's sitting in here. So they give their money, so you use that money, you put it to your investments and other uses, for example. So this uninterrupted compounding never stops, plus you are getting that investing kind of returns from that money. This is the reason it's called and asset. That same dollar, the power of the same dollar is being used at two different places.
That's I think that is the key right there, and you explained it really well to me in one of our meetings. I was utilizing a somewhat similar method of borrowing against my 401k in order to
Mm-hmm.
invest. And another thing that we'll touch on in a second is the fact that you're paying yourself back the interest. And in a
Yeah.
401k, that's very appealing. You take your loan, you're paying yourself back interest, not the bank, but that dollar is only working for you once. It's not staying in the 401k and compounding and earning. I've taken that out and I'm putting it back in as I pay it
Yes.
back off. But that dollar can only be used one time versus in the infinite banking, that value is growing two times. And I think that's just absolutely
Absolutely.
incredible.
Yes, and a lot of people actually like that, and they kind of get, kind of caught up with that concept that if not, I'm not paying myself, it's not doing a good job. But again, when I say that, change your perspective, when you kind of have that eagle's eye perspective and then look at from a different angle, that things actually look, quite a bit the fact that they are, right? So the 401ks, like you mentioned, that you are, if you're, it's 100K, and you take that 50K out, your 50K actually physically came out and then invested. And even if you're getting that 15, 20% returns on that investment outside, inside it's zero. It's not
Mhm.
only that it stopped earning, but it stopped your uninterrupted growth of the compounding. So those are the two disadvantages. And if that infinite banking system, that money is not physically coming out, the initial years maybe it's just growing slowly, but we want to go to that years where it can create that exponential snowball growth for your money. And because of this reason, sometimes people even misunderstand another concept, thinking that, oh, infinite banking takes time, I cannot use that money immediately. But that's again a misconception. It's a long game for sure, because we want that uninterrupted compounding, and starts really, really creating that kind of a value snowball in the later years. But if you say start your infinite banking system with 50,000, 100,000 a year, and you can access, significant amount of that money, and our aim is to have that accessibility for you. When I'm creating that structure, right? So you can access within the first week of it, a good chunk of it, not 100% of it, but a good chunk of that money, to kind of start that snowball. You can invest that into somewhere else and still create that inside growth together, right? So two things to keep in mind from this, that it is, you are not paying interest to yourself, because when you're doing that, you're losing that uninterrupted compounding of your money, and it's being used at only at one place, that's the investment. But here you are using it as an asset at two different places. And the second thing is that when you are utilizing this concept, you are building that parallel path of income for you. And that uninterrupted growth, that's really important.
So when you're borrowing against it, you're saying you're not paying any interest back. You're just paying that principal back.
So you are borrowing, it's just like a home equity loan, right? So it's going to be somebody else's money. So either it's insurance company, or you can go to the third party. And by the way, this is the money, it's based on your collateral sitting in the cash value, right? So there is no hassle about borrowing that money. You can go to the insurance company, say that, okay, I want to take a leverage loan against my policy, and they will have some percentage, and maybe about 5-6% is in the current environment. So you pay them that interest. And
Okay.
I always kind of it's again the perspective of it, right? You don't want to create the compounding of the interest that you want to pay to the insurance company or the third parties. So
Mhm.
you pay them that simple interest. So instead of, if you don't want to pay it back immediately, you can start paying just the interest portion of it. You don't want to add on to it, compound it, right? And inside you're getting that compounding interest. So you're utilizing the big chunk. If you want to utilize, take a leverage from it starting the first year itself, putting it into, say, investment, for example. If you have an investment which is giving you 7-8% cash on cash, and it has a capability of about 15 to 18% annualized returns, what you can do is that the cash flow that you're getting, try to offset some of that interest that you need to pay back. And when the actual money comes in, you can pay back the loan, and you now have the delta that you have created based on what that return of the that particular investment is going to be. And that way you kind of growing that investment, growing that the compounding inside, and you have the two grows together for the same dollar at the end of that period. And then you kind of rinse and repeat if you want to
Mhm.
do that. Now especially for somebody like you have younger kids. By the way, 9-month old, congratulations, that's a
Thank
that's a
you.
great addition to the family. But when you start building now, you want to utilize it for investing, or you want to utilize to grow it, you can do that. By the time it becomes that education timeline, now you can borrow from it, not for the investment purposes, but for the education purposes. And by the way, when they when you're saving, suppose you start a 529 plan that's tied to the education, and if they get any scholarships and grants, etc., they cannot utilize that money that's left over in their 529 plan. You've got to have the penalties to withdraw, and tax implications. This money that you're saving for the education, if they don't get it, if they don't utilize it for the education purpose, it can still continue to grow, and you can utilize it for completely different purposes. Now you can utilize it for your retirement if you want to, but that you cannot do that with the 529 plans. And that's another important aspect of it, that you start building it once, utilize it for whatever purposes that you want, retire with, have a retirement income, and whatever is left over gets passed on to your heirs. That is tax free, so it's income tax free, right? So they don't get any income tax taxed on that. There is of course federal limit on what the estate taxes are. Currently it's 5.2 million per person, but till that point this money is going to come as a single check to them as a tax free, kind of passing on that generational wealth. And this is why I'm insisting on that, right? That growing, preserving, protecting, and passing your generational wealth, it's almost built like a vault. It has automatic asset protection in most states. When you keep your money in bank and if somebody sues you, that is the money that's liquid, that's accessible to the creditors directly. But money in this banking system is a life insurance system, right? So that's actually not accessible to creditors. So that's kind of, in most states, it has that asset protection kind of a wall built around it. Even for colleges, for example, right? When you complete the FAFSA form for your kids' college education, they kind of analyze all your assets and liabilities, and they look at your savings account, brokerage accounts, things like that. But there is no place to put this money. So the life insurance money is not calculated inside the FAFSA, and that kind of helps a little bit with grants and scholarships, etc. as well.
Very cool. What you just said about passing on that um, large chunk of money to your heirs, that goes into how some of these families, the richest families in the U.S., have created and maintained wealth over generations. Can you touch on a little bit about that?
I will definitely talk about how they have implemented this concept, right? And it's astonishing to see, a person like Rockefeller, for example, right? They have built the life insurance system, kind of the infinite banking way, right? Which has that high cash value, generation after generation. In fact, even today, when a new baby is born in their family, they start having this banking system for them. They build it up. By the time they're 2025, they have a huge chunk of money sitting in there. Now they can utilize it for, their businesses, whatever they want to try, kind of pay them for themselves back, kind creates a discipline for them, right? But here is the thing: when we think about life insurance, we think about life insurance as to kind of secure our liabilities when we are kind of alive, right? So we think about that if something happens to me, my family needs to be protected. Say my kids' education needs to be covered. Maybe my primary home needs to be paid off, and maybe my spouse to have some kind of income, kind of cash flow that can be generated from some chunk of money. And that's why most of the time we end up taking a term life insurance only during that period, about that 30 years or so. We think that, okay, that's where I need to cover my liabilities. After that, I'm retiring, I don't need to care about the liabilities. But that's not how wealthy think, right? In terms of life insurance, you can get life insurance which is about 20 times or 25 times, depending on your age, of your income that you're earning. So if you're earning, say, 100K, 200K, for example, you can get at least 20 times, that's $4 million death benefit on your life insurance, or equivalent to your net worth. So imagine that, if you create, instead of having that merely $1 million term life insurance, now if you can get that 2 million, 3 million life insurance, now you have been creating your wealth, and you have that life insurance sitting at the end of it. And when your generation changes, at the passing of the next generation, you have what you have created as a bucket, and you also have the life insurance. The life insurance is kind of protection for your family, because no matter when that death happens, your human life value is bigger than what that term life is going to offer you at any point. So that's understanding the human life value of it, and life insurance, considering the life insurance to cover that human life value, is the key component of it. And looking back, we talked about Rockefellers, they have used this system. Walt Disney, actually, when he was planning to create the Disneyland, his dream, kind of an idea about theme parks, etc., lenders thought that's kind of crazy, and they did not believe in it. So he actually went back to his system. He borrowed from his cash value from his life insurance and some other sources put together to start creating the dream that he had, like the Disney World dream that he had, right? Uh, Again, looking back, Jesse Penny in 1929's crash, it was a humongous crash. Everything just came tumbling down. This system is so strong that it's, it offers you guaranteed growth, and it has never toppled during the recession as well, right? It has passed through a Great Depression as well. So in 1929, then Jesse Penny had no money. Markets had crashed. He went back to his life insurance system, borrowed from his cash value to pay payroll for his staff. Otherwise, Jesse Penny wouldn't have been able to survive through that cash. So those are, some of the examples that come to mind. And this is why we have to change our perspective from that term life, and which kind of, by the way, wears out. I call term life similar to kind of renting a house for your life for 30 years, and all of a sudden year 31 comes, you don't have anything that you have created. All the money that you have put in is down the drain. It has, paid somebody else. So term life is like that. Merely about 2 to 3% time is the probability that insurance companies have to pay for the term life. So putting that money instead into whole life, making sure that it's providing you that death benefit no matter when you die, it's a very essential mindset change that I would encourage the listeners to look into.
Wow. Now, another thing we discussed. So, when's the right time to get started on this? It seems like you described that the very wealthy are starting their children out when they're born on these type of policies.
Great question, Doug. Absolutely great question. People often come to me and they say that, is it too late already? I'm in my 40s. Is it too late already? Well, I wish I had known about this system when I started my first job. I would have, instead of contributing to the 401k, I would have started doing this. But the right time to start this system, if you have known about it, is really the now is the right time, right? I have implemented it, for somebody who has started working, first job, first salary, to put that system in place for a person like him. I have done that for even somebody who's at, 55, 56, that kind of an age too. So you can really implement at any time you want to implement. Your entry points is going to be a little bit different because, in our intention is to have that growth of money, right? So to at least have a significant amount of money, about $1 million or so when you retire, you need to kind of, change your entry points at that point. So if you start early in your 20s, your entry point is going to be different. You can achieve something by doing, maybe 12,000 a year, something that somebody who's in their 30s, maybe a little bit more, 40s, maybe about 20, 30,000. So depending on what your entry point is, it is going to be a little bit different. I give a poker table analogy. When you go to a casino, the first table is like the lower minimum, right? Maybe $5, $10. As you start growing up, then it becomes 50 and 100, things like that. So with your age, that is going to be one aspect. So you have to remember that, your entry points is going to be different per your age. But that does not mean that, you cannot implement on anybody else, right? You can implement on your spouse, you can implement on your kids, especially when some people come to me and say that, hey, my health is not right. Because no matter what, we have to remember that this is based on a life insurance chassis, right? So your age and your health is going to be, the actual table is going to be based on these two components. So if your health is, somewhere that you are not insurable, for example, you could do this on your spouse, because the intention is to build this system and achieve that uninterrupted compounding in your family structure, right? So you can still own the policy, you could still feed into the money into it, but you can create it for your spouse or your children, whoever wants to create, right? I like to think about creating on kids whenever you can, at 9 months age, or 6 years, or 12 years, or 18 years, whenever you can, you start that system for them. Maybe start feeding their education money in that, so they have that responsibility that, okay, my education money is available to me, but I have to leverage from it and I have to return it back to my bank. So that money becomes their foundational for building maybe probably their first house where that down payment will come from them. So they kind of can repurpose that money significantly in their own life cycle. So you are creating a discipline for them. So again, going back to your question, yes, now is the right time to utilize it because it's based on the age and the health. At least one thing is going to change for you tomorrow. If your health remains the same, your age is going to be different tomorrow. And you are, if you are thinking about implementing it now, what happens is something becomes really, really, really important for us on the day that we are thinking about it, listening about it. The next day the importance become 50%, and next day 50% of that. So it's kind of a diminishing scale of the importance, and then within a week you're just going to lose completely that importance of it. So I always say that the time to implement, if something is really, really important for you, it's not tomorrow, it's not even today. It's the time to do and take that action is now. So if you want to take that action and reach out to me, about just learning more and thinking about, okay, what can I do and is it a right strategy for me? You can reach out to me. It's my small short link is going to be bit.ly/call think, and you can get in touch with me. Just a 15-minute call. Let's see what you can do. And if you want to have that free strategy session, I offer that as well for an hour. And Doug, I mean, you have an experience that 1 hour can be such a mind opener, such a kind of that education. I take that simplicity, that step by step. It's an eye opener, and you understand so many concepts behind it. So if you want to take that action, the time to take action is really now.
Great. Well, thank you so much. So you gave a link, and we'll try to put that in the notes. Can you give the listeners how to find you on the internet? Any social media,
Absolutely.
website,
Yeah,
email?
absolutely. So think outside the stocks. That's me. Think outside the stocks. It's not just the outside the stocks kind of strategies, but it's also that out of the box philosophy for me. Something that you have not heard about. Understanding that and bringing that in your financial structure, I'm passionate about, and I'm on a mission actually to change the financial trajectory of one family at a time and thousands more to go. And if your listeners, you want to start that kind of a strategy, which are 20% of strategy that can make that 80% of impact, get in touch with me. ThinkoutsideTheStocks.com, that's my website. You can learn more about me. I also have a podcast, Think Outside the Stocks, the same podcast, where I look at and talk to industry experts, and I also educate based on these things that I'm passionate about. So the infinite banking, the real estate syndication like Huda, and also bring in the guests, which are different industry experts, which talk about that growing, preserving, protecting, and passing your generational wealth. So it's not just about focused on like a streamline, just focused on the passive income and the returns, stuff like that. It's actually that holistic perspective of your financial trajectory. And think outside the stocks, on Instagram, on Facebook, on LinkedIn. That's my handle everywhere. You can find me there. But if you are thinking about that, this is an important key aspect of your financial structure. Take that action now. I mean, go to my website, schedule a call with me, jump in. We also have some membership areas, which are again like a vault, which is accessible free of cost to you, where you can learn and have more visual kind of a presentations as well on both these topics. So make use of all those opportunities.
Well, thank you so much, Madhavi, for sharing all your knowledge with our audience. And thank you, folks, for listening to this episode of the Passive Income Power Podcast. And let us help you find your passive income superpower.
Thank you for watching the Passive Income Power Podcast. We hope you gained wealth building insights. I will ask you to do 3 things to help us serve you best. Go to our website at 2dinvestments.com, click on Investors Club, and fill out the basic information to have timely access to new offerings. 2, follow us on Facebook, Instagram, and LinkedIn. And 3, feel free to set up a call with Doug or Mickey through our website. We would love to help you find your personal superpower.